Hello there, traders. Welcome to the Market in 3 with me, John, Senior Market Analyst at Anzo Capital. I'm here today to bring you the interesting stories of the markets and just let you know what's going on in the Forex space, as well as some key charts to watch. Maybe a couple of trading ideas thrown in there as well. So let's kick it off with the chart check today. We are actually taking a look at Euro US dollar. We had an interesting day yesterday where we saw the US dollar lose a lot of its strength, but then rebounded in the afternoon because of all the geopolitical uncertainty within the markets. So really interesting day yesterday. We had a lot of geopolitical tension, which caused the market to go into a little bit more of panic mode. If we just take a little look at the 2-year bond yields at the moment, we can see that price has been continuing to push to the upside here. That is helping that US dollar strength narrative. At the moment, it is driving gold prices down back into this $4,000 level, and is also seeing the US stock market fall as well. Yesterday we had a little bit of a up and down day on the stock markets because volatility is also rising as well. So more reports overnight that we saw more attacks from the US on Iran, and that has obviously fueled this little bit of US dollar buy-in. The best performing asset against the US dollar at the moment is the New Zealand dollar. We've had some more hawkish comments out of the central bank there over in New Zealand, and that market has continued to rally. One suggestion we looked at yesterday was potentially short on Aussie Kiwi, and that market has continued to trade lower. We can see it's broken out of these kind of key structure areas, especially this kind of upward trend line in here, and the market broke, retested, and has continued to drive lower. So Aussie Kiwi could still be a little bit more vulnerable going forward. We are coming into some areas of support, so I do expect some kind of rebound here. But Aussie Kiwi is definitely a market to keep our eye on, especially from those hawkish comments. But let's go to euro dollar. Obviously, when we take a look at it from a bigger picture perspective, and we have a little look at what's going on the daily chart, we can see that price is breaking down. We're still in this overall downward trend. We've just taken out the 114 handle again, and also this kind of trend line support that is anchored on the 24th of June, and formation at the 1st of July candle. So formed back through this low, anchored through on the 1st of July, and that trend line has now broken to the downside. Quite interestingly enough as well, we can see market just really failed to break through that 114.50 handle, which was also a very interesting level to us because of what happened sort of in last month's trading. If I just pop a market profile across last month, we can see that the value area low of last month was that 114.50 handle, and we can see that price has tried to break into last month's value and just continued to fail. There was kind of like a high sort of volume node around about 114.62 as well, which got rejected as well. So euro dollar still looking a little bit more vulnerable to the downside here. Still like the idea of potentially selling this market, but we have some big data to come today. We have the US CPI data coming out this afternoon. We spoke at length yesterday about the different outcomes that could occur because of that, and I'm expecting maybe we actually get a little bit more of dollar weakness following through. And the reason being is largely down to the fact that the market is expecting a hotter CPI. But, oil prices have been falling for some time, and there is a forecast that we are going to see lower inflation. The reason why dollar is strong right now, or the US dollar is strong right now, is because of the geopolitical tension that we're seeing in the market. Okay. If I know that is escalating, but if we do see some kind of de-escalation combined with a lower CPI number, then perhaps, the market that has been pricing in those rate hikes could start to fall. But like we said all the time, the key is going to be watching those bond yields. If we do see the US 2-year yields at least continue to climb, we are trading now at sort of 4.3%. If we see this continue to climb, then the dollar's going to remain strong. We need to see this kind of fall in order to see that US dollar weakness coming through, and CPI could be that catalyst. Today, we do have resistance up around 4.38%, so maybe a shot into that area before seeing a bit of downside. But for me right now, I'm very much watching this downside on the US 2-year yields to see if we get any, essentially. US 10-year yields trading up at 4.6% at the moment. Looks like they're going to continue to climb at this current moment in time. But, usually when we start creeping in around about this 4.7%, we can see some downside, which again would be likely to see sort of that US dollar weakness creep in. Just taking a quick look at oil prices, they are higher, right? If we take a look at the daily chart, especially on WTI right now, we were trading down towards $66.50 not too long ago, and 2 weeks later we're trading up at $80 a barrel again. So there's a good chance that this will continue because of the escalations in the Middle East. But how is that going to relate to CPI? We're going to have to take a look at that a little bit later. Usually oil and CPI do follow each other. If you look at the United States, let's have a little look if I can get CPI on here. Let's go to economy. Well, let me just put in inflation. And we'll just hit new price scale. Go to a daily chart. So you can see here the correlation is pretty strong, right? When you see oil prices moving higher, eventually CPI follows. However, look, we have dropped significantly since the last CPI reading. So I'm expecting downside for CPI. The one real note we have to keep an eye on is core CPI, right? We have to keep an eye on core, and we have to keep an eye on the PCE index to come after, really, because we want to see how our consumers, is there demand in the market for consumers? If there is, then that's a different picture, because what the Fed are going to be looking for is persistent inflation. So we're going to have to keep an eye on that as well. But yeah, this tells me that CPI is going to come in a lot lower. Obviously, if Brent crude oil, WTI continues to drive higher as well, that will bring back the persistent story of, okay, maybe CPI is going to continue to rise, because basically what happens is businesses, their costs go up because of fuel prices. So market relies really heavily on energy and oil. And if energy prices rise, then, usually producers and businesses, their costs will rise. And what they'll do is they'll pass that on to the consumer. It's whether that demand is there for them to continue to buy those products at those levels. So that's the kind of interesting chart to have a little look at going into today. If that does continue, then obviously we've got a little bit more upside in the US dollar, and the US dollar index at the moment is trading around about the 101s at the moment. We can see we're in a pretty strong uptrend on the US dollar index, right? Obviously, we just checked out euro, which is in a downward trend, which is the inverse of the dollar index. And we are trying to kind of break out. We are trying to make that move to the upside into potentially back into the 101.75s, which would mean euro dollar could trade lower back into the 113.50s at least. So I'm keeping an eye on this one today. I think in the short term, heading into CPI, the dollar is a little bit stronger today. When I take a look at the 30-minute chart of euro dollar and look at the market profile, we are trading back within yesterday's value area. We are trading back towards the point of control of yesterday, around about that 114 level. So if we stay below that 114, then we could look for potential shorts back into current day lows. If we break above high and move higher, maybe yesterday's value area high could be a little bit of interest. We take a look at the day before's trading. Let me see if I can get market profile box for here as well. Let's get you over there a second. When we take a look at the previous day as well, we can see that price came all the way up into the value area high, rejected it, continued to roll over yesterday. So that was a nice little opportunity for a trade. If you were looking at market profile yesterday, there was a nice little move in there for you to have a little look at, which was nice. I didn't end up taking a trade yesterday in euro dollar. I was waiting to see how price would react going into the US session, but it did continue to drive down, and we did see price come all the way down into that 113.77, which is something we talked about when price was trading up at the 114.50s. So looking for a little bit more of a reaction here now. It might not be the most sensible chart to trade today if we are expecting some big moves out of CPI a little bit later. Taking a look at gold. Gold is obviously going to be impacted by those rising yields as well. Currently, price is sort of down. We shot down yesterday as well. The market fell, 1,179 pips. So if we're looking at it in dollar terms, we were trading up at the 4100s, and we were trading down towards the sort of 3970s. So we lost quite a lot of value yesterday on gold. Looks like this trend is going to continue down as well. We do have some strong levels below. 3962 could be a good support point. We have found support towards that sort of $4,000 level and consolidated, broke higher. So, I'm looking to potentially get back on this short again today if we do see a retest of yesterday's value area low, 4,042. Look for a potential short on gold. But again, it's all going to depend on how CPI comes out a little bit later today. If we do see some real strong CPI numbers, then gold prices could continue lower. I don't see that happening. I think everyone is predicting a really strong CPI. And usually when the crowd is pointed one way, you want to kind of go against that. Just, that's just me talking from what I usually see. That's not definitely not advice, but that's just something that I see happens quite a lot in the markets. So if we do see a weaker CPI number and we see US yields drop and we see it reflected in the yields, then, gold prices could trade higher today, back towards the point of control of yesterday at $4,060, perhaps even towards $4,100 an ounce. So keep an eye on gold today. It's going to be an interesting market to watch. That being said, we have some other data coming up today. Let me just bring this in. Let me just select all for today. Filter. I'm just going to reset the countries. Click Canada. Or sorry, tomorrow, I should say, really. So it's tomorrow. We've got a big day as well. We've got the Bank of Canada interest rate decision coming up, which is what I'm going to talk about on the big story. So the big story section of the stream is me talking about the big macro events that are in the market. Yesterday, we talked about US CPI. Today, I want to talk a little bit about the Bank of Canada monetary policy decision. So it is forecast for the Bank of Canada to hold interest rates at 2.25%. So they're not looking to cut interest rates. But what's going to be interested, or what we are going to be interested in, is the Bank of Canada press conference after the fact. Okay, so there's been some key talking points. We are, like I said, expected to see interest rates hold at 2.25%. What we are looking for is the tone, the signaling, the consensus. What is the Bank of Canada members expecting to happen in the future? Now, the way we can kind of look at this and get a little bit of an insight is by just going over to tradingeconomics.com. And this is what I like to do. I like to look at the current sort of impact of the market is happening on inflation, growth, and employment. So if we take a look at the GDP rate, okay, if we take a look at the previous, it was minus 0.2% GDP growth rate. Last was 0. So growth, not looking too great. If we look at the annual growth rate, it's 0.7 minus 0.1%. Okay, they had some good data essentially recently, which was the fact that unemployment rate came in a lot lower. So it was previously 6.6%. Unemployment rate was 6.5%. So that was a little bit of a shock to the market last week. I was trying to sort of buy dollar CAD last week, but it hasn't really been working out too well for me because of the fact that we had that sort of interest, that kind of surprising data from the stock market, from the employment data. Trying to get my words out today. I was basically looking to see if dollar CAD would stay within this trend here or this sort of range. See if we can get that kind of bullish momentum. Hasn't continued, right? The market has continued to just kind of fall away, which is okay, because if I take a look at the overall daily chart, still very bullish here. Still very bullish. So I'm looking to see if we can still take advantage of this potential move here. Again, need a lot of catalysts to come in to kind of help us with that. I think the Bank of Canada will be happy that the unemployment rate is falling. They're still probably not going to be happy with the GDP growth rate, and inflation is still higher than expected. But I guess within that sort of target range, we're trading at 3.2% now, was 2.8% previously. So inflation has been rising, but still kind of around that 3% target range. So looking at what the Bank of Canada could potentially do going into tomorrow's situation is it's all going to be around, like I said, the implications of what the central bank says. If we do see the central bank come out and emphasize that they're not happy with inflation, and we could see the policy rate remain restrictive, if they start saying things like that, that's probably a little bit more bullish Canadian dollars, right? Now, if we take a quick look, let me just show you this as well. So this is an interest rate probability tracker from Financial Source, and we can see that at the moment, there is an 8.5% chance of a cut, 91.5% chance of a hold, and the bias at the moment is neutral. Okay, so that basically means that the majority of central bankers feel that current interest rates are at a relatively good place, right? They don't need to be cutting anymore. They don't need to be hiking at all. So that to me is a sign that they're not really expecting too much. Okay, there's a little bit of tone here, a little bit of notes that we can kind of read through. It says the majority of BoC bankers are neutral, dovish 2, neutral 3, hawkish 0. So they are, neutral to dovish. The overall tone is neutral because the majority of policymakers at the Bank of Canada are currently leaning neutral, with no strong inclination towards tightening or easing. Recent comments from the Governor Macklem and other officials highlight a cautious approach, acknowledging the soft state of Canadian economy and rising inflation expectations. So they're expecting inflation to rise, right? But the soft state of the Canadian economy is due to that GDP growth. Yet they emphasize the need for nimbleness in policy without committing to a clear direction. The mixed signals from various surveys indicate concerns about inflation and recession risks. So again, not particularly good for the Bank of Canada. but also a recognition of the current economic conditions being neither overly restrictive nor accommodative. So that's what I was saying earlier. They don't necessarily think that they need to cut, but they don't necessarily think that they need to hike. So they're in that sort of neutral camp right now. But is the tone going to change? If they think that inflation expectations are going to go higher in the future, then that tone might change. It might become a little bit more, from less dovish to more neutral to hawkish. Okay, that would be positive for the Canadian dollar. Okay, especially against the likes of the US dollar. If, however, we see them come out and say, actually, we think we are restrictive enough, we don't think that those inflation expectations are going to impact policy going forward, and they just think that it's, just a short-term supply shock issue, then the likelihood is that we'll see Canadian dollar weakness continue. Now, the key for us is to figure out where the best place to trade that is, right? So when I look at this interest rate probability, we can see the BOE, hawkish, BOJ, hawkish, RBA, a little bit hawkish. It says the RBNZ is neutral, but I would actually say they are leaning a little bit more hawkish, to be honest. And they are expected to hike interest rates. There's a 75.6% chance of an interest rate hike. We even had some recent comments, recent remarks basically saying that, they are positive and that they could potentially continue to hike rates going forward. So really speaking, the New Zealand dollar is one of those markets that I really want to take a look at against something like the Canadian dollar because of that kind of interest rate differential potential coming up. So if we take a look at New Zealand CAD, for instance, there's no surprise that this market is moving higher, right? You can see that we are starting to break into the kind of 8160s, 8170s now. If we take a look at the weekly chart, market has started to rebound over these past 3 weeks, and that's because the tone of the central bank has changed. Okay, so if we're looking for opportunities, maybe Kiwi CAD could be one of those. We do have a lot of consolidation going around that 0.81 handle. That price has really recently made a new high from. So currently at resistance at 81.82, so around that sort of area here. A little bit of resistance there. But if I was looking to potentially buy this, there'd be two things that I'd be looking at. First of all, I'd probably be looking at sort of swing lows. Okay, so we've got this support down towards the 81.35 handle, which was that previous 4-hour swing low. So if we breach that, that's not going to be good for our idea unless we kind of come back into this area of support around about that 81 handle and we get kind of like a bigger sort of rise from that. Alternatively, we could be looking at price coming back down into these kind of 4-hour support levels around about that 81.30. Look for a lower time frame change of trend. Look for a bit of a bounce to the upside. But currently we're kind of at resistance. We've got that 81.80 barrier right now, which is all this resistance in here. So obviously, if you do want to be a buyer of this market, it doesn't make sense to buy here, right? Again, I always come back to this. Look at it in terms of your reward to risk ratios, right? If I was to buy now, where am I going to have to put my stop loss? It's got to be below at least the 4-hour swing low. So if that's the case, I want to be as close to that level as possible to be able to maximize my reward to risk ratio. So that means I'm going to be able to have a 3-to-1 potential risk to reward ratio. The closer price can get to that 81.30 and reject, I can maximize that. So keep an eye on that, on this one. This could be a good market to watch in the future if we do get a significant breakout. Another one, obviously, we talked about there was CAD yen. That is rallying at the moment, though, and that's more down to the yen weakness in the market. So again, probably avoid that one. But pound CAD could be a good market to take a look at as well. You can see I've got an alert around about that 188 handle already. You can see this was a strong level of resistance in the past. Market is potentially coming back down into this level to test it as support. So I'll be watching the 4-hour time frame here. I will be looking to see, can price, you can see already we've had that kind of double top pattern. Can price form, a double bottom? Can price reject in around this 188 handle where we've seen resistance and support in the past? And if it does, can that give us a buy opportunity to trade it back up to the 1.9, maybe even the 1.9050 handle, which was these recent swing highs? So, you know, when I look at these opportunities in the market, I want to always then refer back to, well, what currencies are strong, what currencies are weak? That's going to be able to help me, you know, find opportunities in the market. Let's move on to the last thing of the day then, where we talk about the skill of the day. And we often talk about sort of different tutorials that you can do to upskill yourself as a trader. I've only got a couple of minutes left, so let's talk about something super simple. So I want to talk about how you can adjust your properties and stuff on your MetaTrader platform. Really simple. So, you know, you've got a few different areas on your charts that you can use. So you've got your market watch area, for instance, you've got your terminal area, you've got your navigator area, right? These are all different areas that you have and that you can adjust to different sizes. You can move them around, you can add them to different areas. Now, one thing I like to look at is, you know, TradingView is a very popular tool these days, right? Now, when you first open your market watch, it's probably going to be on the left-hand side. So a quick tip of how you can make it look a little bit more like TradingView, first of all, is by dragging your market watch over to the right-hand side. So if I bring up TradingView, you can see we've got the chart on the left and we've got the market watch list on the right-hand side. So now in our MetaTrader platform, it looks exactly the same. So if you want to see how you can make it look a little bit more like TradingView, that is a possible option for you there. You can also bring your tools over to the left-hand side as well. So if you don't like your tools being all the way up here at the top of your screen on MetaTrader, you can add them to the left-hand side of the chart. So maybe you leave your time frames at the top, but you have all your tools come down here on the left-hand side instead. So this is now making it look a little bit more like your TradingView terminal, okay? And that's how you can add that little bit of an element to that there. Properties as well, really easy to change. So let's say you're drawing a toolbox, but it comes up as the default setting. Just double click. Now on MetaTrader, you're going to have to make sure it's highlighted with these little rectangular boxes before you change anything. Right click on the properties, and you can change all different settings in here: the style, the size, the parameters, the visualization, which is always really handy, especially if you have lots of drawing tools on your chart. Okay, so that's just a quick one, skill of the day today. I don't want to take too much of your time. That's just how you can make your MetaTrader platform look a little bit more like TradingView. So thanks for watching. I hope you enjoyed this one. If you did, leave it a like and subscribe, and I'll catch you soon.